go. All right, everyone, welcome to the Game Changer Show. I'm your host, Mike McKay, and this week on the show, we have Travis Watts. Travis, welcome to the show.
Hey, Mike. Thanks for the invite. Thrilled to be here.
Yeah. So, Travis, for the people who don't know you, could you give a little bit of background on how you got involved in the real estate business and kind of how that's led you to where you are today?
Sure. Yeah, happy to. So the journey really started pre Great Financial Crisis with a bunch of books and reading. And I just knew I wanted to get into real estate in some capacity somehow at some point. Just stars didn't really align for me until 2009. Real estate was going on sale. I was looking to buy my first home anyway, just to move into. And I got introduced to a new concept at the time called house hacking, or AKA having a roommate. And, I just come from out of college. And so that just made a lot of sense to me as I was single with no kids or pets or anything. So I bought a little 2-bedroom townhouse in 2009. This was in the fall, in September, and ended up kind of renovating that place. It was a value add property. Got a roommate for a while that helped pay the bills, and then ended up basically flipping it a couple of years down
Hmm.
the road. And just all aspects of that journey were eye opening to me. Just the fact of
Hmm.
passive income, someone giving you a check every month on the first, was kind of cool and unique. The value add component, I really enjoyed fixing this place up, making it nicer, newer, and safer. And then the
Mhm.
capital gains on the back end when I sold, and being that I actually lived there as an owner occupant, there were some positive, tax advantages to that as well. So that really got the wheels turning and led me into single family home investing, which I did for
Mhm.
about 6.5 years. That
Mhm.
entailed a lot of different things. That was uh, fix and flips. That was Airbnbs. That was basically doing the strategy I just explained on my first home, 4 or 5 times over after that, until I got into a serious relationship and was committed to that, and decided roommates weren't really going to, be very fashionable moving forward. So, transitioned in 2015 to full-time commercial real estate investing. So investing a lot in syndications, real estate private placements,
Mhm.
but a lot of other things as well. Some dividend paying stocks and ETFs and REITs and some options trading stuff. And so at the end of the day, it ended up being a full-time passive income or cash flow investing strategy. And then I just started teaching others based off not only what I had learned, but my mentors, a lot of the groups and masterminds I was part of, all that kind of stuff. Just want to give back and share. So joined forces with Joe Fairless at Ashcroft Capital.
Mm.
I wanted to leverage his, not only his podcast platform. I was a podcast host for 2.5 years on Best Ever, but then also the Ashcroft platform, where I could get into these conferences and events and, high net worth individual networking opportunities. And so I've been doing that now for about 6 years. So it's kind
Hmm.
of been this 50-50, 6.5 years active, 6.5 years passive. So that's kind of where we're at today here in 2025.
What made you in 2015 decide to make that transition from like, okay, I'm going to be this active investor to be, I know you say passive, but obviously you're actively managing it, but cash
Yeah.
flow focused kind of investor.
Yeah, cash flow, to me, and this is highly personalized, but to me, cash flow started to become the answer to everything I was really looking for, because when I
Mhm.
was doing everything active, it was, you're out there hunting. And if you take your foot off the gas, there's no money, and so you want to go take 6 months off or something like that. Good luck, because you don't have anything
Mhm.
coming, through the door. So, um, it was a combination of, when I was experimenting with the active portfolio, there was one property I remember in particular that I listed on VRBO, Vacation Rental by Owner, and Airbnb. And all of a sudden, that thing started kicking off some serious cash flow. I mean, I was getting like a 25% annualized return off this property. And I
Mhm.
started thinking, God, if I just scaled that up and I had, 5, 6, 7, 10, this is a viable solution to retirement or early retirement, or replacing a job, or call it what you will. There's all these different terms: financial independence, financial freedom, whatever. So I didn't want to take it, though, to your point, from the active side. Like, I was going to
Mm,
go buy 6 Airbnbs. I was going to go manage 6 of them, because all of a sudden now you're a professional landlord. And again, you're back to the grind of having to do everything yourself and being responsible all the time. You got turnovers happening constantly. So these syndications, I was informed about them through a couple mentors in a big real estate group I was in Colorado. And these guys had been doing these private placements as limited partners for like 20 years. They sold their
mm,
business. They were business partners. There was just two of them. This was in the mid 90s. And when they got their windfall from the sale of their business, they just started to diversify and invest in all kinds of things. But their bread and butter was value add multifamily syndications before it was ever really
mm,
popular or widely known investment class. So that
mhm,
was really intriguing to think, okay, I could still get cash flow, I could still get equity upside, I could still get tax advantages, I could still be in real estate, but I don't have to really do anything. I'm just going to partner with a
mm.
group that's already doing this stuff. And I could just be, a number along with, 100 others. And we could partner and pool our money together, do larger deals. So that's really how it started. That was the eye opener in 2015.
And like when you were making that transition, people talk about passive income all the time, but when you're going from doing something actively to doing something passively, like typically if you take like a fix and flip, right, versus a passive investment, like the return is much higher on a fix and flip, but you're doing work
Yeah.
for the return, right?
Right.
So how are you
Right.
able to like kind of make that transition but still like maintain enough stuff for your lifestyle that you were living?
Yeah. Yeah, that's a great question, Mike. It to me, it's like the game goes that when I was early on doing my first deal, my second deal, and my third deal, and being active and doing it all myself, my my return profile back then, this was, again, to
Mhm,
remind everybody, 2009, 10, 11, 12, 13, 14, 15, was probably in the 20 to 30% annualized range. But
mhm,
as a caveat, and for everyone to remember, I was doing a lot of work. It was getting to the point where it was literally becoming a full-time job. So you should have a pretty sizable and healthy return, in my opinion, if you're going to
mhm,
go out there and do all this stuff yourself. And so that's what I was getting. Not every deal was a home run, but they were largely successful in that kind of way. So then the pool of money started to build, right? And so if we just use an
mhm,
example, I'll give you a couple examples to think about. If you're working with, $50,000 and a 10% annualized return or something like that, it's really not that impressive on a monthly basis, but when you get to $1 million,
mhm,
10% is what, $8,300 and some change. It starts to become more meaningful. So my
mhm,
returns came down, just to
mhm,
be, frank and honest about it. They came down to like a level of more like 15 to 18%, so in some
mhm,
cases almost half of what I
mhm,
was getting before. But again, the beauty was I could just walk away from them. I could just set it and forget it. I could, deploy the money, go on a vacation for 6 months, and be getting, monthly paychecks from that. So
mhm,
that's kind of the game, and I've seen this with my mentors too, the two that I mentioned earlier. One of them has about 40% of his portfolio in insured municipal bonds that are only yielding him like
mhm.
3% a year. And so you think about having $100 million invested, 3% tax free, insured. I mean, it starts to make a little more sense. So, if you're someone with 10K, that might not be, your first asset. But you start to see that theme as you start to get into the higher net worth individuals. A lot of people put kind of that safety net around the portfolio because it can be lost. Not easy to make it. It's
Mhm.
real easy to lose it. So, yeah, that's kind of how that unfolded over time.
So you decided to make this switch to passive, right? And then I guess part of being like a limited partner or passive investor is obviously finding the right general partner to put your money with. How
Yep.
did you go about making sure that you were going to find the right person who wasn't going to lose your money and was going to give you 15 to 18% returns.
To be honest, I'm not perfect by any means. I've invested with groups that I would never invest with again. I've lost money. I've had total wipeouts on certain investments, complete losses, and I've had
Mm,
double your money in 3 years type scenarios. So kind of everything in between. So really, what it was is again highly individualistic, if that's a word. But you need to
mm,
basically learn what criteria entails, meaning, geographic
mm,
regions and asset class and business plan type. And, you need to start to read or study or podcast or whatever to get a general knowledge of what's out there and what's possible. And then kind of input criteria based on your specific goals. As I mentioned earlier, I started to see that passive income was a path I wanted to pursue. I love the
mm,
flexibility. My wife and I love to travel, and it's nice just to get up and go. We're not, we live in Central Florida, but we could easily move anywhere, right? We could go live in California if that's what we want to do. It doesn't really matter. And when I was first starting out in real estate, everything was in Colorado. I lived in Colorado. Every
mm,
property I owned was in Colorado. And I was realizing there's a lot of risk to that. You may think you're diversified as in, oh, I have, 15 homes. Well, they're all in a 30-mile radius. So what happens if a blizzard hits or ice storm or a tornado, or the governor says, we're going to implement a 10% state income tax, or what, anything can happen, and all of a sudden
mm,
everything. So I started kind of falling in love with the concept that I could have a property in Florida, North Carolina, Colorado,
mm.
California, whatever. I don't have one in California, but
I was about
but
to
I
ask
could.
that. Do you really have one in
So
California?
yeah, yeah, I know you're a Florida guy too, so I had to throw that in there. But every
Yeah.
time I think about investing in California, I have to throw it back out there. I wouldn't do that, but
Yeah. So I'm sure your criteria has changed over the years and what you're looking for in your investments, but maybe if you could share some of the criteria that you personally look for now, maybe based
yeah,
on things that you learned over the years.
yeah. Yeah. So, unfortunately, with private placements and syndications, it's not as easy to do your research and your due diligence as it is on a
Mm,
big publicly named company, that's a stock, because with
mm,
a stock, take Apple or Microsoft or something, there's like a million websites you can go to, and you can look at PE ratios and trailing 12s and this and that and the other and historics and dividends and blah, blah, blah. Well, with a syndication or a syndication group, some of them may only be, 3 years out of the gate. There's not a lot to look at. They may own a
mm,
few properties, taken nothing full cycle yet, so it's a little more of, the way I always look at it, it's a relationship business. So I look for like-minded individuals,
mm,
analytically driven, value-add business plans, Class B properties. There's
mm,
certain regions I really like for different reasons. There's certain regions, California, that I don't
mhm,
like for other reasons. So again, I don't want to plug in my criteria to your listeners because it's not the end all be all or the best solution for everybody. It's just what I look for. And then the last thing I'll say about it is, because I know your show's not just a real estate show, but
mm,
this, what we're talking about, this passive income strategy, if you will, or investing, philosophy, it could be tied to anything. I mean, you could do this with vending machines or
mhm,
ATM machines or car washes, or conversion of raw land, or renting out boats or yachts. I mean, there's so many different things there's literally thousands. I wrote a book called Passive Investor Tips a couple of years ago, and there's a chapter in there where I just literally go through like 100 different options that you could do for passive income, because I think a
mm,
lot of people get overwhelmed or don't understand how many options there really are
mm,
out there. It's easy to think, oh, high yield savings account, bonds, whatever. People come up with an insurance policy or something, but there's so much more than that. So I'd
mm,
encourage everybody to at least think about or consider, because you and I were talking earlier, but like some of these real estate investment trusts that are publicly traded, they might trade for $10 a share. And if you have a brokerage account, which these days is basically free to open, and you have a minimum balance of like $100, you're in business. You know what I mean? You can start buying shares of that REIT. It starts pumping out a dividend every month. you're
Mhm.
on your way. So I started setting my son up with that, who's about to turn 4. I set my nephews up with that as a first step. It's not that,
Sure.
again, I endorse, the Wall Street and the brokerage accounts, and that's my primary thing. I do that stuff, but I also do a lot of real estate and other things too. I just think there's a beauty in receiving, income without having to be actively tied to that business.
Yeah. So you mentioned like it's definitely a relationship business. So
It
it
is.
like how did you find like where did you
Yeah.
go to find the right relationships to meet the right people?
Yeah, so I like to try to do things at first myself. That's just how I was brought up and just who I am. And so I started with kind of that mentality, which was unfortunate. It was a real big setback for me in single
Mm,
family. I just thought, I'll figure it out. I can do it. I mean, other people have done it. I'll do it. I don't know. I was very naive that I didn't realize how much of a team sport it is, and so I'm really not a good underwriter. I'm certainly not a good handyman,
mm,
and there's a lot of things I'm not good at. Um, so to answer your question, I started with reading books, listening to podcasts, doing things on my own, thinking this is how I'm going to network with people without actually contacting people, which was silly. And so I ended up going to more and more conferences. I started out local with more like meetup groups of 10 to 15
mm,
people or something. Then I was part of a large establishment. We got about 600 people now in that group. So I watched it grow and grow over the years. And then I started doing the national conferences like Joe's Best Ever Conference in
mhm,
Salt Lake City every year, as an example, and ones like that all coast to coast. I've been doing that for years, and naturally you meet people. I mean, that's the whole point, right? You're there to network and swap cards and network. So that's how I found a lot of sponsors. I wouldn't say
mm,
all of them, but I would say 60% came from some form of meetup, or I listened to them on a podcast and gave them a call. I mean, this
mm.
industry is widely accessible. That's another thing I don't think people realize. It's like when you're reading a book and you think, what if I sent that author, a letter or something? A lot of times they'll reply, and it's kind of surprising. But anyway, I just started reaching out that way. And then from there, it was some other LPs in my network, some other passive investors, and who are you
Mm.
investing with, and what's your experience been, and who wouldn't you invest with, and those types of conversations. So it's evolved, and those that haven't done well or underperformed for at their own fault, I'm not going to be doing new deals with them, and so I've been doubling down with some groups that really have over delivered.
What have you found like obviously you've done a bunch of these different investments at this point. Like what have you found as like traits or trends in the ones that overperformed versus the ones that maybe underperformed?
Yeah, it's funny, but I think there's a lot of truth to, the the shinier the brochure, the worse the deal. Some of the deals that I got in, that was just one email, and it was like, "Hey, first come, first serve. Who wants in? We only have X amount of million available." And then the next day, subscribed, over, done. A lot of
Mm,
those groups actually did really well with those, because what that's showing you, by the way, is these groups have momentum. Okay. Now, momentum is earned
mm,
through trust, so the reason they're subscribing their deals so quickly is because they have trusted investors in their network that keep coming back for more and more. And every deal they do subscribes faster and faster in a general sense. Um, and if you're having to just push and push and push and push on the same deal, there may be a reason that people aren't that excited about it. So that'd be one thing to think about.
sure. Anything else come to mind of trends that you've noticed there?
Yeah, I would say in general, it's kind of a weird one to think about, but
Mhm.
those groups who are truly vertically integrated, which means that they manage their own properties, sometimes they do their
Hmm.
own construction management, they do their own asset management. Now, this isn't always the case, so I got to caveat this, but in general, these groups are going to be more in the game. You know what I mean? In it for the
Mm,
long haul. They're really in it for the business and to stay in the business. Whereas I saw a lot of syndicators start popping up in 2018, 19, 2020, and 21 that were literally like, go to a boot camp last weekend, start capital raising this week, and then try to close a deal next month. And
Mm,
they're trying to flip a property for a quick buck, but they're not really in it for the long haul.
mm.
And so I did a few of those student deals and others just to diversify. And in a general sense, the the results weren't great from that. So
Yeah.
just my experience, but
So obviously, recently, at least from what I've heard, I'm not really in like the commercial world, but I've heard it's been a pretty challenging time
yeah.
in multifamily. What's been your experience, call it, in the last 2 years?
Yeah, the last 2 years in particular. Well, actually, let's start with 2022. Okay,
Mhm.
actually, I want to start real quick with. Let's just go back to the start of the onset of the pandemic. So, 2020 was a big scare, right? Everything shuts down, things are unknown, rents start to fall, pricing comes down, everything fell apart really in the summer and spring of 2020. But then we had this magical reopening. Everything's going to be fine again, and not only is it going to be fine again and back to normal, but they're pumping stimulus out there. People are spending left and right. They're investing in everything. They're buying homes. They're getting rentals. We're seeing double digit rent growth in 1 year. I mean, it was insane in 21 and quite frankly, a pretty big red flag. In 22 is when things started to get challenging because inflation
Mm,
started to peak, wages started to go up, and the Fed says we're going to start, increasing rates. Now, what really caught the industry off guard this time is that if you go back and look at what the Fed was saying in December of 21, they were
mhm,
saying that they are going to increase rates, but modestly and to about a 2 to 2.5% Fed funds level over the
mhm,
next 2 years. Well, they went over twice that much. So they went at the most aggressive pace in like 40 plus years in American history. So we took it to five and a quarter. And so that was really tough for people who were underwriting in 21 for future
mm,
growth, right? Because with increased rates comes a decline in prices, right?
mhm,
Because the next buyer is going to have they need to cash flow that property. So if your cash flow is only 6% in 2021 based off your debt and your purchase price, and let's say your mortgage is 3%. Well, now think about what happens if you have a 6.5% loan on the same property at the same price.
mhm,
You're not going to cash flow. That 6% just got eaten up because the debt cost. So you have to, as an owner, you have to discount the price to the next buyer because
mm,
they have to deal with this higher debt so that they can cash flow for themselves and they can get a 6% return or something like that. Because if you can't, you're not going to buy it. Why not just go buy a bond and get 4% and just leave it alone and not have to have the headache. So we've seen a collapse in pricing. We've seen stagnant rent hovering
mm,
around the 1700 range for the last 2.5 years.
mhm,
Um, Now we're seeing in the last 18 months, in particular, hyper supply hitting markets because these developers got all excited and antsy in
ah,
21 as things were blowing up and thought, well, we want to get in on this. We want to make some money here. Um, and unfortunately, it takes several years to build. And then when they brought them to market recently, right, prices are down,
sure.
concessions are up. And so we're all out here competing with this really nice product that's hitting the market at a huge discount. So imagine that you're a renter and you're like, okay, for the same price, I can go rent this 1985, class B apartment, or I can go rent this class A brand new luxury apartment at the same price point because it's an
Mm,
artificial rent because they're trying to fill up their occupancy so that they can offload this property to somebody else. So
mm,
it's been challenging. I do not want to discredit that in the least bit. We've all been damaged, directly and indirectly. I mean, I've written off hundreds of thousands over the last couple of years, and the reason I want to come on this podcast and other podcasts like yours is because I believe that right now we're starting to turn the corner back into the
mhm,
recovery phase, which is
mhm,
to me is like it's the perfect timing, really, because you get the full run up of the next cycle. And so this is where, developers are pulling back. They're not building like they were. And we're going to get back to a supply demand imbalance. Rents are going to start to trickle up from here. Rates are projected to come down from here. So it's kind of like what was the perfect storm 2 years ago is now almost like the opposite. It's the perfect opportunity to kind of
Mm.
ride up the wave. So if you haven't been damaged too bad in the last couple years, or you've been thinking about getting in, it just reminds me of the parallels of when I got started in 2009.
Mhm.
I wasn't ready in '07. I just wasn't ready in 2008. But by the time 2009 rolled around and you start seeing the writing on the wall, similar to right now, it's like, it just makes a lot of sense. You're going to buy the dip, get a discount, cash flow from day one, maybe be able to sell or refinance early if rates do come down. So we don't bank on that kind of stuff, when we underwrite, but um, you know, pretty much every source is suggesting similar stuff. So hopefully we see a really good return here in the next 5 years or so.
What did you see that, like, on that way, let's call it the way down, right?
Yeah.
2022 and maybe about now, like, what do you see? Did you see like the operators who like made it through, who were good
Yeah.
operators doing versus the operators who maybe they either didn't make it through or they took some pretty heavy losses?
It's a great question. So a big part of the problem is that in commercial real estate, as compared to single family residential real estate,
Mm,
uh, it's common to have floating rate debt. It's common to have bridge loans,
mm,
which are very short term loans. I'll give you this money today, pay it back in 12 months, that kind of
mhm.
stuff. The problem is when that 3% rate goes to 6%, what do you do?
Yeah.
So a lot of these deals, they first of all, they went underwater in the sense of pricing. So like you bought something, imagine, just let's use some simple math. You bought a single family home, to use that as an example, right? And you put 20% down. Well,
Mhm,
now what if home values fell 20%? Well, you're completely wiped out at the moment. If you
mhm,
had to sell, that means every dollar you put into that piece of real estate is gone, because
mhm,
you got to pay back the debt and there is no equity. So we started seeing pause distributions. We started seeing capital
mm,
calls, having to ask investors to bring more money to the table so that you can either refinance, which, the game changed, right? Normally you think of a refinance as a positive thing where you go to a lender, you cash out some of the money, potentially tax free. You enhance your cash flow and you move forward with the business plan. Maybe you recapitalize the property. Well, now you're having to bring money to the table to do a refinance and get a worse loan than what you had before, which is crazy. And then a lot of these groups bought these interest rate caps, which is kind of like a insurance policy. If rates come up, they can only go up so much if you have a
huh,
cap. The problem with
okay.
the caps is they went from, in our case, say $100,000 in
Mhm.
21 when rates were really low, to $1.1 million just 2 years later. So if you want
Sure.
to go rebuy the same cap, where's your $1 million times every single property that you need one for?
Mhm,
So, that can put you in a bit of a pickle there. So I would say resourcefulness is one thing of the groups who are making it through thus far, and
mm,
who I believe will make it through, because again, it gets back to the experience. You need to know people in this business. That's what we were talking about earlier. It's a team sport,
mm,
right? So if you're green, you're new, you only know a couple people, and now your deal's underwater going south and you don't have options. Like, you don't have the net worth, you don't have the cash cushion, maybe you didn't do the right underwriting. Like, it's really hard. So I've seen some operators just walk away from the
mm.
business. I've seen some fraud, very limited, but some fraud occur. You start to see the real personalities, behind the folks doing these deals. So, not to scare anyone off with that stuff, but it's real. And again, that's the beauty. And when I started to realize that I could work with people smarter than me, more resourceful than me, people
Mm,
who live and breathe commercial real estate every day. I'm talking about the analysts that are on our team in our New York City office Monday through Friday, just crunching numbers, crunching deals. I hate doing that stuff. That's not me. It's never going to be me. I can't be that good if I tried. I'm just not. So it's nice to leave that, to others sometimes in certain instances, but equally so, because I don't want to persuade everyone here to be a passive income investor like me. If you have a skill set or an upper hand advantage or connections or network or what have you, even just a genuine valid interest in real estate, I want to get my hands on it and do it myself, do it. There's nothing wrong with being active. It's just for me, it started to get a little tiresome. I started to realize it really wasn't my highest and best skill set as I got 6.5 years into it. But it's a common story, by the way, but it's not everyone's story.
So then, obviously you said now is, the beginning of like what you believe is a great opportunity. What are the good operators doing now to maximize that opportunity?
The good operators now, this is where it gets back to resourceful, right?
Mm,
So if you're, for example, with Joe and Frank and Ashcroft here, we got awarded a deal in Dallas directly through a lender that we had done business with before, who
mhm,
knew not only do we operate 43 assets in DFW, not only have we done business with them before, but that they have the certainty that we're going to close the deal and that we know what we're doing, so they didn't want
mm,
to take chances on going and listing this and going with some random person they don't know, right? So they came
mhm,
directly to us at a discounted price and said, look, first dibs, you want it, take it or leave it. Now that being said, even though Ashcroft is a strong operator, as many others are as well, it doesn't mean that investor sentiment is in your favor, right?
mm,
Because everyone else has been burned by all these other instances and groups and things happening. And so even though you've got a great deal that maybe has great projections or cash flow or blah blah blah, it's one of the tougher sells now because all
mm,
these limited partners are saying, yeah, I would, but I got these capital calls. I've got all these pause distributions. I just lost my money over here on this deal. And so the appetite is not near what it was just a few years ago, where if you were a solid operator, boy, you could just close these deals fast, you
yeah.
know, in a week or two. And now you're talking about, sometimes months and months and months. So it just depends. But
So that deal that lender brought you, was that a property they had taken back from a borrower who defaulted, or what was the scenario?
yeah, so this is an example of a newer syndicator who, bought it at peak pricing in 21, right? They got maybe 20% through their business plan of renovating, ran out of cash, couldn't
Mm,
bump the rents, couldn't do a refinance, had floating rate debt. It was never going to work, So they had to hand the keys back to the lender. Lender called us and said, basically, here's our debt balance, it's yours for that price. So, and not only was that cool to, I mean, I say cool, like caveat, of course, empathy and sympathy towards those that were in the deal previously. I'm not trying to make light of that situation, but cool that the lender offered that kind of price. But furthermore, and even better, because we bought from the lender, they were able to work some terms with us on the interest rate that otherwise could have never really happened realistically. So in today's environment of high rates, because we just closed this deal earlier this year in 25, we would have had to pay about 6.5% on an interest rate. But this
mhm.
lender did like a 2.5% year one, and then like 3/4 for years 2 through 5. What's a paid in kind interest that accrues and gets paid upon sale. So, long story short, not to confuse your listeners, but basically it came down to a 4.5% rate, but we only have to pay a portion of that in current every year. So it's kind of like a teaser rate,
Huh.
but even if you don't look at it that way, it's still a discounted rate on top of that. That's really almost impossible to find, or at the time when we closed it was impossible to find. So some cool creative strategies came out of it. Same thing with the Class A deal that we closed. Similar instance. syndicator out here in Central Florida, had to basically, they did more or less a short sale. It wasn't a foreclosure. They didn't have to hand the
Mm,
keys back. But again, it was relationships through Joe Fairless, one of our GPs. And he was actually in that deal as an LP. And then he's like, hey, I might want to buy this deal, for our group. And so it was an easy change of hands that way with a lot of trust and relationship built in. So certainly an opportunistic time. I know it's hard for so many people to see all of this nuanced, detail, because most of our
mhm,
investors are doctors and dentists and lawyers, and they don't really have their full-time focus in real estate. But
mhm,
um, yeah, there it's a this is why, I'm so excited and so bullish, is I get to see all this stuff behind the scenes and really kind of live it and
mhm.
breathe it and understand that, like, fundamentally some of these deals are better than any deal I've seen in the last decade.
Sure.
Not every deal, but plenty of them are, to the tune of 25-30% off, and cash flowing deals and solid fundamentals.
Yeah. So with it being more challenging to raise money now because obviously some of these investors got burned by other groups and things like that,
Yeah.
like how are you guys going about raising capital and what allows you to do it?
Yeah, we've made a few changes to the model, but honestly not a lot. We've just kind of accepted the time frame difference, knowing that before, if we had this deal, it would take a month, and now it's going to take us 4 months or whatever it is, and
Mhm,
as long as we can adhere to something like that, like, we're not going to put a deal under contract that must be closed in 30 days, because we're not going to close it in 30 days,
sure.
but again, we have some resources, some connections. We have GPs that have been fortunate enough to have gone through enough full cycle deals successfully, where
Mhm,
they have a little padding there, a little cash reserve, if they had to jump in and close a deal themselves or something, because we
mhm,
were a couple million short or whatever it was. We've worked with licensed broker dealers. We've worked with a few fund of funds. We've worked with a few family office. So we've widened our net to where
mhm.
we used to be just individual limited partner with an average
Oh,
check of maybe 100K. But, we've always had a low minimum too at 25K. So you can imagine how long it takes to fill a deal of $30 million raise with 25 and 50Kers.
sure.
So we had to make a few changes in the last 2 years. So
So I guess, and I'm not as familiar with like the multifamily side, and maybe some of the listeners aren't either. So when you go to raise money for a deal, are you raising money for like a portion and then there's some debt that goes along with that? Or are you guys raising and paying cash and then refining later? Like what's kind of like the process? Typically, I mean, I know it's different in every deal, but typically.
yeah. No, that's a good caveat. Every
Mm,
deal is different, but in a general sense, you're at least going to have, or in our case, you're going to have a senior lender, which is usually, for us, it's
mm,
agency debt. So like Fannie Mae, Freddie Mac, this kind of stuff.
mhm,
They're usually going to come in at 60 to 70% leverage, which
mhm,
means that we're putting, 30 to 40% down these days. We used to put more like 25% down, but since everything happened the way it did, we're being more conservative. So you're going to have that piece, senior lender, and then you're going to have equity. And so everybody like you and I, individual investors, are equity. Okay.
mhm,
So we might have to raise $15 million. So we're going to do that with a bunch of people saying, I'll do 100K, I'll do 100K, I'll do 200K, he'll do
mhm,
300K, that kind of stuff. And then you own a percentage of a limited partnership. Limited partnership owns the property. We've done fund models, we've done individual deals, we've done two-pack portfolios, we've done debt funds, we've done a lot of different structures. But in a general sense, that's how it works, is debt and equity. You can have pref equity and other layers and mezzanine debt and all this kind of stuff, but I won't bore your audience with all that.
sure. And then how does it work? I mean, the limited partners are guaranteed a certain return before the general partners get paid, or there's a split there? Like, how does that typically
Yeah,
work
so
on?
typically how it works is we're a group that offers what's called a preferred return. Now, a preferred return is never a promise or guarantee, because we can't legally do that, because you can't legally ever know that a deal is going to be a success. What if it's not, right? And then you're on the hook for paying all this money you don't have. So a preferred return means that the investors get paid first before our company gets paid. So basically, if
Mhm.
we are not delivering at least a 7% annualized return every single year, uh, first of all, if we can't pay it out, then it accrues and you're still owed that, assuming that it's going to
Oh,
be there in
okay.
some form or fashion at some point. Sometimes that comes in a refinance later down the road. Sometimes it comes at the sale of the property. But basically, you look back and you say, okay, we've had this deal 5 years. Let's say we paid investors in year one and year two. And then for some reason, we had to stop the distributions for 3 years. So we would need to catch them up 7% year three, year four,
Mm,
year five. Okay, now you've made 7% a year. Then we have a what's called a waterfall split. So it'd
mhm,
be, for example, like 70-30, 60-40, 50-50. Like there's going to be a split on the back end. But to your
mhm.
point, every deal is different. We give more equity in the deal to investors based on how much you invest in the deal. So if you want to go put in our last two deals, if you put 1.5 million in, there was no split. It was a 100-0, which means you as an
Wow.
LP get 100% equity upside participation and 0% to Ashcroft. But if you came in with 25,000, then it'd be like a 70-30 split. So
Sure.
70% to you, 30% to the GP.
Right. So you
Yeah.
guys are incentivizing, having to collect less checks if possible. So
Yeah, I mean, but it's a win-win when someone comes
yeah,
in for 1.5 million, even
sure.
though Ashcroft is all they're really going to make off that is a portion of an acquisition fee. But then there's not going to be a lot after that,
Mhm.
almost nothing. But it helps us close out the deal.
Sure.
So again, like what's the benefit of getting a check for 2 million today versus 25 people saying, I'll do 25K, I'll do 25K, I'll do 20. That's a lot of work. It's a lot of
Mm,
paperwork, logistics, distributions, reporting, K1s. There's a lot that goes into that. So we're willing to kind of cut the profits to the GPs, or I should say they're willing to do it. They're the ones taking the cut in order to make things simpler and easier that way.
yeah. And then are you guys strictly focused on multifamily or do you do other types of commercial real estate?
Yeah, we only do value add business plans in the
Mhm,
multifamily sector in select Sunbelt markets. So,
mhm,
Dallas Fort Worth being our largest, Central Florida being our second largest, other markets throughout Florida, and Atlanta being other markets, and then Chapel Hill, North Carolina. So, we
mm,
may expand over time. But right now, we have good infrastructure with our regional managers and our boots on the ground and our staff and hiring. We're in a good place right now. It's hard, if we said tomorrow we want to start doing deals in Denver, Colorado, we have no infrastructure there, right? Like
mm.
it gets back to the resourcefulness, and it's like, who do we know and who can we hire and how are we going to get materials there and blah blah blah. You got to know all the state laws and all the so we'll probably just keep doubling down, where we do best
Yeah.
in the short term. Yeah.
And are you guys in all those I know you said vertically integrated earlier. Are
Yeah.
you guys vertically integrated, property management, construction, things like that?
Yeah, we do our own property management. And by the way, the company's called Birchstone Residential. So it was created from scratch by us for us. All we do is
Mhm,
manage our own portfolio. We waited till we hit over 1 billion in assets under management before we went vertically integrated.
mhm,
So that's what I mean about some caveats. Like we were crushing it before we did that, but it just further enhanced what we could do if we had that kind of control over the
mhm,
portfolio. Then asset management in house, and then construction management in house. And then we have our own procurement process now, which is a
mm.
streamlined process of getting custom materials made from overseas, shipped to warehouses that we have set up in Dallas. And then we can truck our own materials to our own properties, and they're pretty standardized across the board. We have the
Huh.
same finishes and color schemes and palettes and the whole deal. And so there's a lot of cost savings associated
Yeah.
with that as well. Yeah.
That's interesting. That almost sounds like an entire, like, business on its own. I mean, just having
Yeah, it
yeah.
is. It is. It'll probably branch out. I don't want to say too much about it. I don't know too much about the future of it, but it was launched by Frank Rossler, our other GP and our CEO. And I mean, it makes a lot of sense in my point of view for other syndicators, especially those less
Yeah.
connected. having to rely on local retailers and shops for materials. Because just think about going down to Home Depot today and saying, well, I need 450 shower rods right now. Like, it's costly, it's inefficient. You're going to get these big old colored cardboard packages with styrofoam and plastic, for every single shower rod. It's a mess. It's a nightmare. So to be able to order, you know, 5,000 of those in one box, without all the extra packaging at a 30% discount shipped to us is beneficial. Gives us an upper hand advantage for sure.
Yeah, it's funny you mentioned that, like getting a bunch of boxes. You never think it's a big deal, right? But I used to be in the short-term rental part of real estate like quite a long time ago. And when we
Yeah.
were setting up units and when we really started to scale, I was like, man, I thought boxes were not an issue, but when you're onboarding 20 units at a time and you get 50 items in individual boxes, you're like, this just added like this incredible amount of labor just to even get rid of the stuff, like the junk. So we ended
I
up
can't
coming
even
up with a different
imagine
solution for that. But yeah.
the scale. No, it's a great point. It's a great point. I mean, I know just from the last 2 weeks at our house on Amazon how many packages we have. Trash
Right.
people won't even pick it up. It's a
Yeah.
mess, but it's not environmentally friendly, to approach it that way. At the scale that we're doing it anyway. I mean, we're almost 3 billion under management now. I mean, that's just tens of thousands of units. So you've got to come up with a better process at a certain point.
Yeah.
Yeah.
If someone were to say, okay, like, I'm interested in passive investing, like, they've maybe started listening to some books and podcasts, but they haven't really done anything beyond that. Like, what would your suggestion be is like, what's the next step that maybe they should take?
Always try to find people that are really doing it. I don't mean just me. I mean, there's a lot of people out there that are full-time passive investors, right? Like I use the example of my own mentors, those two gentlemen in Colorado. They're the ones that opened my eyes. And to me, seeing is believing. It became real when we started talking numbers and deals. They started sharing the pros, the cons, what to look out for, blah, 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 what their process is. I don't like to read or watch anything where someone's just talking theory about stuff, So
Mhm.
there's a few good YouTubers too that'll kind of open up their portfolio sometimes and kind of share some stuff. So whatever it is, paid or unpaid, in person, virtual, mastermind, like just find somebody that you could see yourself kind of stepping into similar shoes, right? And then
Mhm.
just make them your mentor. Find a way to do it. Add value, work for them, pay them, just do something, to try to get the answers. And I think if you're somebody who can do your own research to a point, and then you can have one or two mentors to kind of bounce ideas off of, I think you
Mhm.
really get to where you want to go pretty fast. And I
Yeah.
know it seems overwhelming and unlikely, but it's not rocket science. That's why I love real estate and I love this stuff because if anything's ever so complicated you can't wrap your head around it, just don't invest in it. Just don't. I mean, honestly, and that comes straight out of my own playbook. When I was younger, this was right before the syndicate. Well, I was right about the private placement stuff, but there was this oddball investment. It was like a debt collection fund that was diversified and in all these states I've never even been to, and blah blah blah. It was weird, and I couldn't even articulate the business plan. But I was like, hey, they say 20% returns. Let's go. Let's do this. And I lost almost all my money. It was almost a
Yeah.
couple $100,000 right there. So hard lesson, but the common sense to that was just like, stop for a minute. Do you know exactly what you're investing in? If the answer is no, just stop. you know, Either learn more and then do it later, or just don't do it. Whatever. So anyway, that's
Yeah.
one.
You were mentioning offline, and you said something. You have this rule for yourself called the 8% rule. Can you talk
Yeah.
more?
Yeah, the 8% rule, which look, again, this is one of those things you plug in your own percentage, but what this is something I came up with for myself as kind of just an overall percentage goal of my own investment portfolio. I
Mhm.
mentioned earlier that some of my early deals yielded 20, 30% returns, right?
Mhm.
And I've done deals as low as 4% returns. So the
Mhm.
point is, I try to make it a balance where I can achieve about an 8% averaged yield on my investments. Some investments do it right out of the gate on day one. You just invest in something that pays you 8%. I've got hard money loans I do at 10 and 12%. So that's
Mhm.
higher, obviously. And then you're always going to have deals underperform where you thought it was going to be 8, but it turns out it's 5. So as these scenarios unfold and you start to kind of find the equilibrium, I just try to balance them out. So if I'm going to do a 4% deal, then I know I'm going to need to do like a 12% deal, and I'm
Mm.
going to have to pull the average up. Or if I have deals underperforming, I'm going to have to go more towards yield and less towards equity upside and stuff like that. So, um, again, I mean, to use a 10% example, it's not too impressive. You got 10,000 bucks at 10%, $83 a month, but $1 million at 10%, 8,300 and some change every month. It starts to become a lot more meaningful. So something I always come back to, and there's a lot of debate over this, but I think it's pretty widely known and factual that markets and investments, on average, if you want to be consistent over the long haul, they return about 8%. Again,
Mhm.
some will do better, but if you are somebody like this crypto stuff drives me crazy. I've had so many conversations with people that are diehard crypto people, and when crypto's doing good, they're out there making fun of real estate. What are you doing with your 8%? I'm making 30% a month. What do you think? And then when it comes crashing down 80%, they're ghosts. You never
Sure.
hear from them again. And that's the whole point. If you're going to go buy Nvidia and Palantir stocks, like, yeah, they can skyrocket up, but they can skyrocket right back down. So you
Mhm.
got to be okay with that kind of risk tolerance. And maybe you are, and maybe you're, kind of more of a gambling mindset. That's cool. You can do that stuff, but just recognize that if you want to be a serious long-term investor, I mean, you got to listen to the people like Buffett, that talk
Mhm.
about realistic returns. And especially as you pump your portfolio larger and larger, there's things I could do right now for $100 where I could double my money tomorrow, right? I'd go
Right.
buy something on Marketplace and flip it for twice the price, right? I doubled my money in 24 hours. You can do that. But when you have $1 million or more, you can't do that. There's
Yeah.
nothing that you're going to go buy and sell tomorrow and just get $1 million out of thin air. So something to think about is, in a general sense, the more money you have to put to work, the more modest your yields are going to kind of level down. So I don't know. 8% rule might be helpful for some. Maybe for you, it's a 6% rule. Maybe for others, it's a 10% rule. It just
Yeah.
kind of depends, but it just sets a benchmark, so that you can track how you're doing stacked up against that, basically.
And are you looking at that as, like, kinda like your just your yield, your cash on cash return, you said not including any equity upside you might get when the property sells or anything like that?
Yeah, this is a yield strategy that I'm talking about. So I'm talking
Okay.
about balancing, and I'm a person that likes monthly cash flow. I fully recognize that a lot of investments out there will do quarterly, and I'm in some of
Mhm.
those, but I really like monthly. It just makes it easier. It's my primary income, so it's like, if you had to choose, do you want to get paid once a month or once a quarter? I think most people would probably choose monthly. So,
Yeah, for sure.
yeah,
Cool. Well, we're getting close to the end here, Travis, and there's always 2 questions I like to ask at the end of the show, and the
sure.
first is, what is the craziest or most uncomfortable situation that you have ever experienced in a real estate deal?
Oh gosh, there's been a handful. One of the worst feelings, I'll just say this, is, please everybody, just do enough due diligence to feel truly comfortable with your decision. There's been a couple deals I kind of rushed, for one reason or another, and I just thought, whatever, I don't have time. Here's the money. Let's go. And after I sent the money, there was a red flag, and it's just
Ah,
too late. It's just too late. And that's one of the worst
yeah,
feelings for me, in your gut. It's just like you knew you just made a mistake and you're probably not going to see that money again.
yeah,
That's painful. So just it's always worth it, man. Take an extra week, take an extra month, take as much time as you need, like I said earlier. And if you still don't get it or feel comfortable after X amount of time, pass.
Yeah.
Pass and do something else. It's always better to save your money and get a 0% yield than lose it all.
Sure. Yeah. Well, the second question I always ask is if you could go back in time, give yourself one piece of advice when you were looking for that first real estate deal, knowing what you know now, what would you tell yourself?
It's a general business rule, but it also applies to investing and entrepreneurship and anything else. And I think that the key is to uh, partner with people who are better than you in different areas. So again, this could apply to maybe just your business partner. Maybe you're super analytical and introverted, and your business partner is a salesperson who's super extroverted. Maybe that's a good partnership. So you want to
Hmm.
kind of partner in that way. You don't want two analytical people with their heads down that can't talk to others. That's not going to be a good partnership, probably. Same thing with syndications. I did some poor renovations on homes. I didn't have the right tools. It took me twice as long as someone else and stuff like that. So that's what was really nice about syndications, is just being able to offload some of the things I'm not good at to others
Hmm.
who really are good at those things. So again, the way I started this whole journey was hard-headed. Um, you know, ego, whatever you want to call it, is like, I can do this. I'm going to do it. I'm going to prove everybody wrong. Like, I'll figure it out. That's not the right approach. I don't think it's to work with other people. It's a team sport.
Sure. Yeah. Well, Travis, if people have questions, if they want to reach out to you after the show, how can they go about getting in touch with you?
Yeah, you can go to speakwithtravis.com. That's my calendar, speakwithtravis.com. Happy to share, take a deeper dive with you, explain anything that maybe wasn't clear on the show. Always happy to be a resource for other investors.
Cool. Well, awesome. Thanks for being on the show, man.
Thank you so much. Thanks, everybody. Thanks, Mike.